Good morning, everyone, and welcome to the second installment of our April Asset Management webinar series. My name is Gary Fitzpatrick, and I'm a principal in the Asset Management Department here in Dublin in KPMG, and I'll be your host for today. As you can see on the slide, this is the second in 5 webinars, running same time, same place every week, 10 a.m. Short, snappy webinars whereby for 30 minutes we'll discuss key topics affecting the industry. The 2nd of April fraud webinar is available for everyone, and you should have a link to that on your screen, so you can click in and watch a playback of that, and registration is also available for the other webinars. So just a bit of housekeeping on the system and the interface. So it's an interactive webinar, so feel free to ask questions and put questions in the chat as and when they arise, and we'll have a short Q&A at the end of the session, whereby myself and Jared will be in a position to answer any questions you may have. You can register for upcoming webinars in the interface as well, so I mentioned that. It is interactive, so reactions, you can share your feedback through emojis, the system facilitates that. And of course, the speaker bios are there if you want to know anything about myself and Jared as well. So without further ado, we'll move on to the webinar topic for today, and that topic is key trends in asset management. And I suppose, has there ever been a more welcome time to talk about this? I suppose that the world is changing day by day as we speak. Asset management companies and firms are navigating change on a daily basis, from global events to regulatory change, political change, and of course the shifts in the technology space that are really impacting firms and companies as they advance their strategies. So keeping on top of these trends in the industry is key for participants, and those that modify their strategy to take advantage of these trends will be the ones that come out with competitive advantage and the results of their strategy as well. So I'm going to hand over to Jared Duffy now, who is a director in our financial services strategy team here in KPMG, and he's going to take you through the key trends in asset management, and we'll regroup at the end for a short Q&A. Okay, over to you, Jared.
Thanks, Gary, and good morning, everyone. Great to see that so many of you could join this morning and take time out of your busy days. As Gary mentioned, I'm a financial services strategy director here in KPMG, so I've over 10 years experience advising firms on growth strategy, deal strategy, and value creation across the financial services ecosystem. So in today's webinar, I'm going to break it into 2 different parts, right? So one, as Gary mentioned, is around the industry trends, and specifically going to look at profitability considerations for companies, ESG, and technology. So in order to do that, I'm going to leverage some research that we've undertaken across the sector. So that was a survey and interviews with 30 senior leaders from across the Irish asset management landscape. Secondly, then, we're going to look at management team responses. So in the context of those industry trends, what can local management teams do to gain competitive advantage, navigate change, and avoid being disrupted? So in light of everything that's going on in the world, I thought it'd be useful to start with a view on how the funds industry in Ireland has shown remarkable resilience in the face of external shocks and macroeconomic uncertainty. So in this chart that you can see here, we're looking at 3 different things, right? So in the light blue is the World Uncertainty Index. So this is produced by The Economist. So their intelligent unit actually tracks the use of the word uncertainty amongst their reports. In the purple line, we have an Irish equivalent. So this is using a similar methodology, but for local press and publications. And then in the pink line, what you can see is then it's just the NAV of Irish resident funds. So on the 2 uncertainty indices, what's clearly obvious is the spikes around previous external shocks. So global financial crisis, Brexit, COVID, and obviously more recently around tariffs, Trump, trade war, etc. But what's showing then in the NAV of Irish funds is the consistent and remarkable growth despite those external shocks and macroeconomic uncertainty. So Key takeaway here is that at a sector level, the Irish funds industry has been remarkably resilient. But that's not to say that at the individual firm level, that the foot can be taken off the gas or can any complacency in terms of the internal dynamics of the industry. And there will, of course, be winners and losers. And then as I speak to further on in the webinar in terms of that industry or management response to those industry trends, give some tips and tricks and views in terms of how your firm can navigate these shocks and changes to the external market. So as I mentioned, we undertook some research across the sectors. This was high level, looking at the key drivers of change around different topics. So this one is just looking at at a high level, what will be the key drivers of change over the next 3 to 5 years. So we gave respondees a number of options across regulatory changes locally and in Europe. Is it digital assets, interest rate environment, industry consolidation, fintech disruption, etc., etc. But the three that came out on top as the most important drivers of change in the sector over the next 3 to 5 years were profitability challenges. So I'll speak to that and around fee compression, etc. The ESG agenda, and then technological advances and how they apply to different actors and players across the value chain. As we move through the webinar, we're going to focus on those three in particular, notwithstanding that the other factors here will obviously have a part to play as well. Okay, so moving into the profitability element, right? So I think, as we probably all know on this webinar, fee compression has been a factor of the market for a number of years. So you can see there in the chart on the left-hand side, the asset weighted average expense ratio of firms has reduced consistently over the past 20 to 25 years. And there's been a number of reasons for that. Okay, so there's been a significant and persistent change from active mutual funds to passive funds and ETFs. There's increased competition, regulatory pressure. Some firms in particular have driven a low-cost agenda, which has caused and required others to follow to compete, etc. So it's been a persistent factor of the market for a number of time, but there is a little bit of nuance in that, as we see recently. So that decrease does appear to be slowing. So as you can see on the left hand side, the curve is flattening slightly post 2020. There are some differences around different asset types. So for example, new mutual funds are getting cheaper, but new ETFs are actually getting more expensive. That could potentially, be a factor in terms of the growth recently of active ETFs versus their passive comparators. There are some geographical differences evident. So, for example, in the UK and the US, there's a sense that probably fee compression has reached a floor. There might be a little bit more to go in other geographies, Luxembourg, Ireland, etc. Also, in terms of niche areas, tend to command higher fees. So, as mentioned, some active ETFs, access to private markets, particularly for retail investors, etc. So anything niche, innovative could obviously command higher fee. And as a broader kind of competitive landscape point, larger players are expected to maintain stable fees, and this may point to further consolidation in the market, which we've seen recently, particularly on the third party Manco side. So I guess. So I suppose to summarize here, fee compression still absolute factor of the market, will continue to be so, but certainly some nuance around geography, asset type, product, etc. So if the previous point around fee compression lends itself to a cost discussion, there's obviously some other factors in terms of profitability that are just driven by the nature of investor appetite for different asset classes. So what we're looking here at is an historic view on the left-hand side. So that's the Irish mutual fund asset mix at a sector level. And then the right-hand side, market views in terms of where the greatest growth profile for particular asset classes over the next number of months. So on the left-hand side, you can see there's been obvious growth that I was looking at from 2013 to 2023 across asset classes, equities, bonds, etc. But you'll see on the right hand side, there's been alternatives that's really shot up, and it's had the most significant change in growth over that period. So, an over 1,000% increase, where it's now on par in terms of size with nearly with bonds, money market funds, etc. So, very much the market view is that that will continue. So, again, we asked a question around, which asset class will have the greatest growth profile over the next 12, 24 months. What came out very strongly was around private debt, private equity, ETFs, traditional bonds and equities, less so. So particularly on the private debt side, that's been a significant trend post-financial crisis from lending, particularly maybe towards the SME mid-market size. There's been obvious opportunities there for private credit to step into that space, and direct lending has been particularly active. And there's certainly a view that that will continue over the next number of years. So then moving into the technology piece. So I think it probably plays through. So it's obviously not in isolation versus the profitability discussion that we've just touched on. So this chart here shows what I would sort of emphasize. This is a snapshot in time. So this was looking at what are the technologies that firms are using and impacting business operating models as of now. So it came across as what's most pervasive across organizations is process automation. And I don't think that's probably not a massive surprise in terms of a cost-conscious industry. And there's a fairly well-known standardized playbook now in place around integration of technology and automation in terms of gaining efficiencies. The one that people may look at there is obviously there's been a significant trend recently around artificial intelligence. So I think it will be quite interesting to see how, if we retake this survey in the next year or two, how that might become more integrated. So it's certainly on top of management team front of mind, but in terms of that embedding it into the organization, there's probably still a little bit of a way to go. So here we're looking, so that was kind of, the previous one was kind of a look at a very high level view of what are the types of technologies that players in the asset management sector are using. So this then goes a little bit deeper then to show what parts of the business is it being used in, and maybe what are some of the challenges as well. So on the left-hand side, and this is looking purely at an asset manager view, but my sense is that other parts of the value chain would have a similar response. And what was quite interesting here is that the integration of technology is quite uniform across the organization. So it's not a case that it's solely around back office operational efficiencies, or it's a case that it's a front end view for clients, etc. It's used right across the organization. So in this example here, it's the adoption is from front office risk management, portfolio management, corporate functions, your research function, as well as back office operational efficiencies. But this is so there's clearly a view that technology is obviously an enabler of growth and can drive out costs, but there are challenges, right? So on the right hand side, we can see that. So it's in terms of where the challenges are, one is on investment required, and two then is on lack of specialist staff. So it was touch on the specialist staff piece. I think it's probably been a boon for the Irish sector in terms of Brexit and ability to attract talent. There are probably some other Ireland Inc. broader issues that are maybe making that more challenging, but certainly the sense that, and certainly with the conversations we had with leaders, that specialist staff piece for technology is critical. And it's often the case that it's non-Irish, right? So it's getting the best people in from across the EU and elsewhere to fill quite niche specialist roles. but still a challenge for many. So moving on then to the third piece then that I want to drill into. So this is on ESG. So we asked the question of around what's the driving force for ESG related activity and change in your organization. So what comes out most prominently here is that it's responding to regulatory requirements. And I would say that this is I think this, considering the level of regulatory change, this is probably unsurprising. The other point I'd make, I'd say if you ran this question to other sectors of the economy, you probably get a similar response, that it's really a regulatory driven agenda, particularly here in Europe. What is interesting though is that on the other side of the equation, so ESG appears not to be considered, or certainly less so, in terms of building sustainable competitive advantage, value creation, how one can differentiate versus peers, etc. And we would certainly see this as an opportunity for firms, but it's probably more of a, for the time being, get through the regulatory piece, but then the time will have to come where the mindset shift will have to pivot, towards that piece around value creation, differentiation, etc. So again, on ESG, so I mentioned briefly there the European regulatory point. So what's becoming quite apparent on ESG, and it's almost becoming now a cultural topic as much as anything else. There's a pretty clear apparent shift now between the US and Europe as it pertains to this topic. So what you can see on the chart on the left-hand side is we looked at ESG shareholder proposals at asset management. So this is proxy voting by asset managers at AGMs. And what the chart is showing is what's the percentage that are voting in favor of ESG resolutions. So you can see, a clear difference between the European view, which is nearly an 80% positive level at the top, and that's dropping then down. So 40% in 2021 in the US for that similar metric. And again, and actually going downward. So it's decreased year on year from 22, 23, 24. So that's kind of almost a proxy view for looking at the importance of ESG as it's considered within asset management firms. On the right-hand side, then, we're looking at the total ESG fund assets globally. So again, this paints a similar picture of EU prominence. So you can see that as of 2024, that's 89% of those, in terms of the split between Europe and the US, is towards Europe versus 11% in the US. Maybe one to highlight here is that you can see obviously the rapid growth in capital allocation to the ESG funds from 2018 to 2021. There was a softening of that in 22, but it's actually back on the rise again. I think this maybe cuts against some of the commentary that you might see around this sector, that in fact, in 2024 you still have, it's still at an all-time peak. But notwithstanding that there has been that pace of growth that we saw from 2018 to 2021 wasn't there, but it has certainly not been the case that there's been massive outflows. In terms of why though, so why we're seeing this difference between the US and Europe, so it's really around EU regulation taking the lead. From a US policy perspective, it's obviously quite different, and there also appears to be stronger EU investor appetite. There's been some high profile cases that I'm sure many of you are aware of in that regard recently. So I'm going to move into the management team response piece now. So I guess this is around looking at in the context of those trends that we've discussed. What can management teams do? So, we've gone through, there are changing client expectations, there are new competitors in the market, there might be parent group expectations if you're a subsidiary. There's an economic landscape that seems to be evolving by the week. There are M&A opportunities, sales and earnings growth aspirations, again, that may be set elsewhere. So there are lots of different factors from an external market environment, the management teams need to be aware of. But the point here is that, doing nothing isn't an option. So, it's been proven time and time again that, a do nothing option is probably the riskiest move that you have. So, it's really that management teams that can adapt and react to change, that we see outperforming their peers. So, and this is validated by data. So on the bottom right-hand side, you can look at EBITDA growth over a 3-year period. This is cross-sector. So companies that have purely a cost focus, yes, grow at 4.4%. That increase if you've got a growth focus. But if you can balance the cost and growth focus, which I think you can really outperform peers, I think that's particularly pertinent within asset management. So a lot of those trends that we are discussed previously, I think initial point of view is it lends itself to a cost discussion, a cost takeout mandate, but there really needs to be an equivalent appetite and focus on growth in a balanced way. And the other point to say is, right, that there's no one size fits all method to improve performance. So there are playbooks, but each company is different, different capabilities, there are market niches, etc. So stepping into how we like to think about solving some of these problems, and this is maybe an approach that might be helpful within your organization. So the key here is that it's really important to get a baseline and a line in the sand on truth of where you stand, both from an internal perspective, and an external perspective. So that means getting to a common source of truth that everybody can align on in terms of both your internal data, but then most importantly, then merging and analyzing that with external insights and benchmarks. So if you can understand where you are versus your peers on the key metrics and key KPIs that are import to your business, it leaves you then in a very good place then to evaluate opportunities. So that means that you have a single source of truth, you have a baseline of where you stand, and then you can clearly articulate and actually quantify then the opportunities that may present themselves. So that could be across growth, it could be cost reduction, it could be around client experience, it could be digital. There are other levers there that may be more applicable to your organization. But this kind of framework and approach gives you the chance to analyze opportunities and quantify the impact. So just a couple of examples of how this has worked. So in terms of some of the work that we have done in our team for different players across the sector. So one was a strategic view of an Irish security services business, mid-ranking player looking to grow market share. Key questions around, do they go for growth or become a more niche player versus avoid being stuck on that middle ground? Two, supporting a global hedge fund, market, for a global market infrastructure company. So that was looking at the European and Cayman Islands hedge fund markets, leveraging that outside in point that I mentioned previously. Use your own data sets, external data sets, etc., to provide a really concrete future support and internal business case. And then again, the approach can be used for classic market entry strategy, which we've done for asset and wealth management firms as well. So in terms of key takeaways from today, so very briefly, I would say the industry is resilient, as I said at the start, at a sector level, but there will be winners and losers at an individual company level. Their impacts of fee compression are being felt across the value chain. This is likely to continue into the next number of years. Technology, product innovation, different asset classes, and ESG, amongst other factors, can offer a path forward, as we discussed, taking that shift in mindset purely from a cost takeout to growth value creation view. And then finally, as mentioned on the last couple of slides, there's no one size fits all. If you take a view of your organization, looking at the internal data, mesh that with external analysis, it can provide an excellent foundation in terms of charting a path forward. So with that, might hand back to you, Gary. If there's any Q&A from the audience.
Yeah, thanks, Jared. That's very, very insightful to go through all that. So we've had a few questions come through, so we have 5 minutes, so we'll take them now. So I'll just talk you through the first one. So I work for a large global organization. How can the Irish leadership team influence performance improvement, given strategy is often done from a top-down setting?
Yeah. Good question. Yeah. So, and this is a common factor with an open economy such as Ireland, where we have lots of large multinational players that have an Irish subsidiary, but also are part of a global parent entity. And yes, it's the case that at the very large group level decisions are sometimes made at the global entity, but that you often find that from a strategic performance improvement perspective, that thinking doesn't filter down into the subsidiary, right? So it's just impossible for a group entity or a group CEO sitting in wherever to understand local market nuance. So I think that's where local management teams can really play a part, and it's about articulating the Irish story, the Irish market, what's different with the Irish market, but then also the Irish entity, right? So what value does the Irish entity play into the group? And then secondly, there's a group strategy, but can the Irish entity strategy be aligned to that? And can it solve some of the big problems for the group? So one example might be, a technology question. So can the Irish entity be a test bed and innovator for new ideas, new technologies, etc.? So it's about understanding the group strategy, but also then seeing where the value of the Irish entity is and playing into that.
Yeah, so a successful global strategy really feeds in from local management in order to capitalize on everything globally.
Yeah. Exactly. Yeah.
Okay. Another question that's come through is specifically on technology. Are you seeing any other specific technology trends emerging in the strategy space?
Yeah. So I think obviously the big one is AI, which we touched on previously, and it's getting, I'd say, the focus of firms, both asset management and cross sector. But maybe the other one that we're kind of seeing that's maybe just a little bit coming down the tracks is quantum computing. So we would kind of have the view is that maybe quantum computing quite hasn't had its ChatGPT moment, but it might be coming. But what we are seeing is some of the more progressive organizations are kind of getting ready for that, and it's really around a defensive strategy. So the major impacts or major risks of quantum computing in organizations are going to be from a cybersecurity perspective. So it's around getting common cryptography methods used today, defense mechanisms for cybersecurity aren't going to work in the future as quantum computing develops. It's still nascent, but the level of growth and innovation within that sector, I wouldn't be surprised to see that as kind of the top of mind for boards. If now people are trying to grapple with how can they integrate AI into their organizations to solve issues, I think maybe 2-3 years down the line, I think people will be having very similar conversations as it pertains to quantum computing.
Yeah, so it's kind of just a readiness kind of check for people to ensure that they're ready.
Exactly. So it's one evolving. That you kind of it's one that the savvy organizations can get ahead of the curve on. So it's about once there's mass adoption across the organization, you want to be the one player that's got ahead of the game and then can capitalize on that.
Exactly. Yeah. Perfect. Thanks very much for that, Jared. So we're right on time, so we might wrap up the webinar there. Hopefully you'll be available to join us for the forthcoming webinar. So next week at 10 o'clock, we have a webinar on human rights and supply chain due diligence for asset managers. So we will hopefully see you then. And thanks for your attendance today and have a great day. Thank you.
Thank you.